So the market had this massive run-up last year, right? And now everybody is asking the exact same question. What in the world comes next? Well, we sifted through all the latest analysis to find the key signals for 2026. Let's dive in.
To put it simply, 2025 was a really, really good year. I mean, despite all the constant worries, from tariff talks to questions about the Fed, the markets just kept on climbing, rewarding investors who had the nerve to stay the course.
And what a reward it was. Check this out. The S&P 500 delivered a total return of nearly 18%. That marks the sixth time in just 7 years that it's posted double-digit returns. It was a true gold rush for portfolios.
But of course, that incredible performance leads us to the crucial question for 2026. With markets flying this high, are we getting close to a ceiling? Is this bull market running on fumes, or is there still plenty of room to run? Let's take a look at the forces at play.
Okay, first up, the single biggest trend shaping just about everything in the economy, artificial intelligence. It's been the undisputed engine of growth, for sure. But it also raises a really serious question. Are we in a bubble?
I mean, the scale of investment here is just staggering. We're talking hundreds of billions of dollars from the tech giants. You've got these massive projects like the Stargate AI venture, which is planning to invest $500 billion. And it's not just talk. Business adoption is accelerating, more than doubling in 2 years. As a result, the Magnificent Seven, the biggest tech stocks, now make up about a third of the S&P 500's entire value. This isn't just a trend, it's a fundamental economic shift.
But this brings us to the first major warning light. The CAPE ratio, which is a key way to measure market valuation over the long term, is now hovering above 39. To put that in perspective, that's the second highest it has ever been in over 150 years. The only time it was higher was at the absolute peak of the dot-com bubble. So the big question is, are we just repeating history here?
Well, not exactly, and this is really important. The key difference is what's holding the market up. The dot-com bubble, that was fueled by pure speculation on future promises, a lot of hype. Today, these high valuations are largely backed by real, tangible corporate earnings. And that matters because profits provide a fundamental floor, a baseline of value, that pure speculation just doesn't have. So, while we should be cautious, the foundation this time around seems a whole lot stronger.
All right, let's switch gears and turn to our next big theme, policy. There are two major sources of uncertainty creating a kind of fog for investors this year. And those are the Federal Reserve and, of course, politics. So in the world of finance right now, people have adopted a term from the sports world, the last dance. Yeah, you heard that right. Just like Michael Jordan's final championship season, the market believes the Fed's next rate hike is going to be the final move in this historic tightening cycle. It signals the end of an era, and believe me, investors are watching for that final buzzer.
This timeline really puts that whole transition into perspective. The last dance hike is expected pretty soon. But the bigger story is what comes next. Fed Chair Jerome Powell's term ends this May, and new leadership could mean a whole new playbook for monetary policy in the second half of the year. That's a huge question mark.
And the other part of the fog? It's political. The midterm elections in November are going to dominate the headlines, no doubt, and probably cause some short-term jitters. But here's where history gives us some crucial context. Since 1933, markets have returned a pretty healthy 8.6% on average during midterm years. Ultimately, the long-term trends are driven by fundamentals, not by all the political noise.
Okay, so beyond the big headlines about AI and policy, there's a more subtle story unfolding inside the market itself. Different asset classes are telling very different stories, and things are in constant motion. Just take silver, for example. In this absolutely stunning run, it soared an incredible 260% in less than a year through late January. Wow, a truly historic rally. But then, this happened. In just 3 days, silver crashed by more than a third. It's a powerful, almost brutal reminder that commodities are notoriously volatile, and what goes up that fast can come down just as quickly. And what's really fascinating is that gold and silver, which we often lump together, were rallying for completely different reasons. Gold was being driven by central banks looking for a safe place to park their money. Silver, on the other hand, was all about industrial demand from new tech like solar panels and AI data centers. Two metals, two totally different stories. And you know what? We're seeing much broader participation across the market. While the S&P 500 had a fantastic year, international stocks actually did even better. Both developed and emerging markets gained around 30%. Even good old bonds played a crucial stabilizing role.
Diversification, after kind of being on the sidelines for a few years, is finally paying off again.
Analysts who study these market trends are also seeing a change in tone. After all those high-flying growth stocks led the charge for so long, there's a subtle but really meaningful rotation happening. Money is starting to move into more defensive sectors. Think healthcare and consumer staples.
So what does all of this actually mean for you? Let's try to bring all these different threads together into a clear playbook for how to think about the 2026 market landscape.
So here's the summary. You've got AI as the main engine pushing things forward. But you have the warning lights of high valuations flashing, telling us to be careful. Then there's the fog of policy uncertainty, which is going to create some bumps in the road. But underneath it all, the market is in motion, with new leadership emerging and diversification proving its worth again.
And all of that leads us to this really powerful insight. It can be tempting to get complacent when markets are strong, but this is exactly when discipline matters most. It's not just about what you buy, it's also about what you don't do, like chasing performance or letting one part of your portfolio get way too big, no matter how exciting it seems at the moment.
Which leaves us with a final question for you to think about. With so many different things pulling in different directions, the AI boom, the policy fog, the market rotations, is the most powerful move you can make to simply block out all the noise and just stick to your long-term plan? It's something to consider as we navigate the year ahead. Thanks for tuning in.